Welcome to our revision lecture on IAS 16. Now, before we dig into IAS 16, I briefly want to touch on different assets standards. Now, you need to be able to identify from a comprehensive question when you read through a paragraph, which type of asset are you currently busy with? Why is this important? You need to identify which standard to apply. Now, I know that our level 1 students do not have to know IAS 40 or IFRS 5. But guys, I am briefly going to touch on principles. Why? It is important for me that you are able to identify different types of assets in comprehensive questions. Now, you need to be able to identify, is this an IAS 40 investment property asset? Remember, investment property are held to earn rental income or for capital appreciation. Or is this an IAS 16 property, plant and equipment asset? This can also be IAS 38, our intangible assets. And for our level 2 students, you need to identify if this is an IFRS 5 asset. Now, to complicate things, you also need to know the principles of IAS 36. IAS 36 impairment can be applied on our intangible assets as well as our PPE assets. Investment property, remember guys, can either be recognized based on our fair value model or our cost model. If at cost model, IAS 36 will be applied. Why? Because our cost model will be exactly the same as per the cost model of IAS 16. Now, what is extremely important to identify then, guys? You will have to review the useful life and residual values of your IAS 16 property, plant and equipment yearly. If there's any changes, this is a change in an estimate, and you will have to apply IAS 8. Now guys, do you see how important it is to ensure that you know all of your different standards? Now let's have a look at our big picture of IAS 16. You will identify that I have included a black horizontal line in the middle of the screen. Now this is a timeline. Now there's about 4 or 5 important principles that we are going to work through, and this will follow the flow of our timeline. Now, what do I mean with flow? Remember, any transaction has to begin on purchase date. Therefore, we will first have a look at 1, our initial recognition. When can we recognize an IAS 16 asset? Then 2, how do we measure this asset on initial recognition? 3, what is the depreciation method used? 4, how do we subsequently recognize and measure our asset? And 5, how do we disclose our PPE note? Then extremely important, guys, you need to know your IAS 12 principles. If you do not know them, you need to go back to the lectures and review them. And we will cover IAS 16 in a separate lecture. Now I'm going to look at our initial recognition only. Now it is important, if there's a theory question for you to discuss, that when you look at initial recognition when an asset is purchased, you need to discuss the conceptual framework definition of an asset. Then you need to remember it has to meet the recognition criteria. And the third definition will be the definition of IAS 16. This definition indicates to us that the asset should be tangible. Now, what is the meaning of tangible? You should be able to touch the asset. And this asset should be held in the use of production. Therefore, guys, think about a machine. goods or services should be produced and the entity should expect and plan to use the asset for more than one period. If your answer is yes to all three of these, your conceptual framework definition, recognition criteria, as well as IAS 16 definition, you may recognize an IAS 16 PPE asset. Now, there's a few important things that you need to identify on initial recognition. Remember, when we talk about initial recognition, this will be your journal entry to debit your asset and to credit bank if this is a cash sale or a creditor. Now let's have a look at the 5 important things that you need to identify on initial recognition. Or guys, if you look at repairs and maintenance, this can also happen during the lifetime of our asset. Immediately you need to know that repairs and maintenance should be expensed. In certain instances, spare parts and servicing equipment should be purchased. Now, it is important that you know that spare parts and servicing equipment will initially be recognized in inventory. Therefore, you will debit your inventory. And when you use your spare parts or servicing equipment, you will debit your expense or your asset and credit your inventory. It can qualify as PPE on initial recognition if it will be used for more than one period. Safety and environmental costs can be recognized if it meets our recognition criteria. Therefore, then we will be able to capitalize our safety and environmental cost. Now, recognition criteria, guys, then you will have to go back to these 3 things. Definition of an asset in terms of conceptual framework, our recognition criteria, reliable, probable, and our definition as per IAS 16. Then our major inspections, very important. You will have to follow these steps. Capitalize the cost of inspection cost if it meets the recognition criteria, and if it does, you need to depreciate. The remaining carrying amount you need to take out and derecognize. How do you do this? You will have to credit your asset with the remaining carrying amount of major inspections. Then on initial recognition, part of the cost you need to allocate to the inspection cost and depreciate over the expected period until our next inspection. Guys, my recommendation, always include a timeline and follow your steps. Now, what will happen if our major inspection costs was not identified on initial purchase date? Now, what does this mean, guys? If we have purchased an asset, let's say on 1 January 2016, and now we identify in August 2016 that there is major inspection that has to be incurred. But on initial recognition date, 1 Jan, we did not identify these costs. You will have to use the estimated cost of future similar inspections. Okay, therefore guys, it is important to read the information provided. Now, number 5, our replacement components, very similar to our major inspections. You will have to capitalize the cost of the replaced component if our criteria is met. The replaced component should be depreciated over the remaining useful life and then derecognize the remaining carrying amount of our replaced component. And then what happens if the carrying amount of the replaced component cannot be determined? Again, similar principle as per our inspection, you need to use the estimated value. Now guys, when there is a question that includes major inspection or replacement components, my recommendation, you need to make use of a table when you calculate the depreciation. Now, important guys, just quickly stop there. If you calculate your depreciation by means of a table, let's say, for example, we have an aircraft. Our aircraft has an engine, and the engine will be depreciated based on hours and is a significant component. And we have our aircraft, which will be the remaining portion, and this will be based on, let's say, 5 years useful life calculation. You need to identify, when you disclose your PPE note, guys, this is still one asset that you need to include. Please, this is still one asset. Please do not include separate columns for engine and aircraft. Okay? Now, guys, I'm talking from experience. I've seen this quite a lot, that students on a CTA level do not know that this is still one asset. Yes, you split them for calculation purposes, but when you disclose it, it's still one asset. Okay. Now, let's move on to number 2. On initial recognition, if you have identified, yes, this is an IAS 16 PPE asset, you need to measure the asset at cost. Now, what is cost? Cost will include the purchase price, and this will include import duties, non-refundable purchase taxes, after trade discounts and rebates, costs directly attributable to bringing the asset to the location and condition capable to operate as management intended. And our cost will include our IFRIC 1 dismantling and removing costs. And we will have a look at this separately. Okay. It is extremely important that you know what type of costs should be included or excluded. Now, guys, I'm going to ask you, please ensure that you flag this section in your standard, the excluded section. Therefore, let's just take this one step back. This is how I've done it. I will always assume costs are included, except if it is specifically excluded. Okay? Therefore, in a scenario when they provide me with a list of costs, I will immediately open my standard and view which of these costs do I need to exclude in terms of my standard. And they like to include this in discussion questions as well, guys. Okay. Now you can work through this on your own. I want to talk about 4 important aspects, the blue block underneath our what should be included or excluded. Now, on initial recognition, you've identified that this is PPE. We need to measure the asset at cost. Now, when there's a self-constructed asset, the same principles will apply as per our recognition. You will have to apply purchase price, costs directly attributable to bring the asset to the location and condition, and you need to be able to identify which of the costs should be included or excluded. Number 2, if there's any deferred settlement, guys, important, you need to identify that you need to calculate the present value, and we will recognize the cash price. 3, government grants. You may deduct this from the carrying amount of our PPE asset as per IAS 20. Number 4, exchange of PPE items. Now, when an asset is acquired and in return for that new asset, the entity give, now let's indicate pay by means of exchanging another asset. And in our example, let's say this is the vehicle one, okay? We need to recognize that acquired asset at the fair value of our acquired asset, unless the transaction lacks commercial substance or the fair value of neither of our assets are reliably measured. Now, guys, When the fair value of our acquired item is not reliably measured, we need to use the carrying amount of the asset that are given up. When both fair values cannot be measured reliably, we need to use the carrying amount of the asset given up. Now guys, our next extremely important item that we need to discuss is IFRIC 1, our dismantling costs. Now I am going to explain this by means of an example as well. On initial assessment, we need to identify from the information provided if there is any dismantling costs. It is important that you need to know that there has to be a legal or constructive obligation before we are able to recognize dismantling costs. If our answer is yes, we need to recognize dismantling costs as part of our asset. Therefore, you will have to debit your asset and credit your provision for dismantling costs. Then it is important to identify that this provision initially will be the present value, and each year you will recognize the finance cost. Therefore, you will debit your finance cost in your profit and loss, and you will credit your provision as your provision increases. Now, extremely important, guys. If there is a reassessment, first you need to identify, are we applying our cost model or our revaluation model? Now guys, I know revaluation model excluded for our depreciable assets, therefore you can read through this paragraph on your own. I want to talk about our cost model, and we will look at an example as well. Remember, you will then have to debit or credit the asset with the increase or the decrease in the provision amount. And extremely important, you need to account and disclose for a change in estimate in terms of IAS 8, and you will have to remember to test for impairment. Now please refer to the lecture examples included in your notes and work through those examples with me. Now I want you to look at our green block, depreciation. Now you need to know we will start with the depreciation when the asset is available and ready for use as intended by management. When will we stop? When the asset is classified as an IFRS 5 asset, or when we sell the asset. You need to know either it can be depreciated based on straight line, diminishing balance, or units of production. Now let's refer to our subsequent recognition. Subsequent recognition, the entity can choose to either recognize subsequently the asset based on cost model or revaluation model. Now you only need to know revaluation model of land. Now let's say, for example, our land was purchased for an amount of 100,000. They indicate to us that they've revalued this at the end of the first year to an amount of 150,000. There's an increase of 50,000. How will you recognize this? You will have to debit your land and credit your revaluation surplus with 50,000. How do you account for the deferred tax? Based on your CGT rate, you will have to debit your revaluation surplus, credit your deferred tax liability, and this will be the 50,000 times 28 times 18%, and this will be 11,200. Now that's what you need to know, guys. Okay. Therefore, the revaluation surplus movement shall be recognized in your PPE, and the balancing amount, which will be the difference between the 50,000 and the 11,200, shall be recognized in your OCI and your revaluation surplus column in your statement of changes in equity. Then there can be instances where our assets are derecognized, either when it is disposed or when there's no future economic benefits to be expected from that asset. Now guys, our disclosure. I have included our property, plant and equipment note for you to study. What is important is that you identify that our separate columns should be added for each class of asset. And my recommendation, as always, this is a template only. You need to leave sufficient lines in your template to add any relevant information from the question, such as transfers to IFRS 5, transfers to investment property, and so forth. Then I just quickly want to touch on IAS 12. Now, it is extremely important that you need to identify the manner of recovery. Therefore, first you need to identify what is the information that they've provided to you. Then you need to identify what is the manner of recovery. And my recommendation, always include a diagram, a timeline, for you to ensure that you understand the information provided. Now, when you look at the carrying amount of a depreciable asset, the residual value will be recovered through sale. Now, let's just talk about what is the residual value. If you buy an asset, let's say now, today, you buy this asset, and the useful life of the asset is expected to be a period of 10 years. Okay. Now, the residual value will be the selling price that we will be able to receive now if we will sell the exact same similar asset at the same age and condition as per our asset that we have purchased. Therefore, guys, this is deemed, well, not deemed, but the manner of recovery will be through sale. Therefore, you need to know when you receive a question and there is a residual value included, please refer to the pink block, okay, where we calculate our deferred tax. And there's a residual value, for example, of 250,000 included. You need to know that the residual value's manner of recovery will be through sale. Okay. Our depreciable amounts, manner of recovery will be through use. Therefore, when you look at this light pink block, if our residual value is 250,000 and our cost 200,000, that 50,000 will be taxed based on our CGT rate. The difference between our tax base and our cost will be taxed based on 28%, and the difference between our carrying amount, remember the carrying amount's manner of recovery will be through use, will be taxed based on our 28%. Guys, I'm going to conclude. Please ensure that you study your principles. When you work through a comprehensive question, you need to identify which asset are you currently working with and apply the principles of that asset on your question. And important as always, your exam technique. Please practice this.